Okay, let's unpack this. We are standing at a really weird, fascinating intersection right now.
Hmm.
On one side, you have traditional investing, buying stocks,
Yeah.
looking at PE ratios, holding for the long term, doing your
The
homework,
boring stuff.
the boring but important stuff.
Yeah.
And then on the other side, you have this exploding world of prediction markets, basically betting on the outcome of future events.
Right.
And the big question we're asking today is, could these prediction markets actually be the next frontier of growth for major fintech stocks? Or is it just, I don't know, a desperate attempt to keep people clicking buttons?
It is the question of the moment, isn't it? Because if you look around right now, here in early 2026, prediction marks have absolutely taken the financial and gaming worlds by storm.
Oh, completely.
It's not a niche experiment anymore.
Yep.
It's everywhere.
It really is. I feel like I can't open a finance app without seeing some option to wager on an outcome. It's staring you right in the face.
Exactly. And that's what we're digging into. We've got a stash of sources today that highlight 3 specific players who are betting big on this trend: Webull, Robinhood Markets, and Interactive Brokers.
The big three, in a way, or at least a very interesting cross-section of the market.
In this context, yes. And our mission for this deep dive is pretty specific. We want to unpack exactly how these platforms are integrating these markets, because they're doing it differently.
Right.
And then look at the hard numbers. We need to assess whether this is just a flashy feature to grab attention, or if it can actually drive future stock performance for these companies.
Because, spoiler alert, the stock performance for some of these guys has been, let's call it an adventure over the last year.
An adventure is a very polite way to put it. Character building might be another way to describe the losses some investors have seen.
I try to be diplomatic. So let's set the scene. How did we get here? Because a couple of years ago, prediction markets felt like this very specific, almost political thing.
Yep.
You'd bet on who wins the election, and that was it. It was for political junkies.
That was the gateway drug, so to speak. But the contextual shift we've seen over the last year, essentially throughout 2025 and into now, is that the space has grown substantially beyond just politics.
Okay.
And before we go further, we should probably clarify what we're actually talking about technically. When we say prediction market, we're usually talking about binary options.
Yeah, let's pause on that. Binary option sounds like scary finance jargon.
Yeah.
What does that actually mean for the user?
It's actually deceptively simple. Binary just means there are only 2 outcomes, yes or no. Did the event happen or did it not?
Yep.
In these markets, you're buying a contract that usually pays out exactly $1 if the event happens and $0 if it doesn't.
Okay, so it's a yes-no question with a price tag attached.
Exactly. So if you think the Kansas City Chiefs are going to win the Super Bowl and the market thinks there's a 60% chance of that happening, that contract will cost you 60 cents. If they win, you get $1. So you made 40 cents profit. If they lose, you get 0. You lose your 60 cents.
Got it. So the price of the contract basically tells you what the crowd thinks the probability is. 60 cents means a 60% chance.
Precisely. And for a long time, regulators were very, very skittish about this because it looks a lot like gambling. But the key catalyst recently was that the referees, the regulators, finally blew the whistle and said, game on. Platforms like Kalshi and Polymarket received regulatory green lights. And this is crucial. It wasn't just for political event contracts anymore. They got the go-ahead to offer sports event contracts.
That feels like the massive unlock.
Yeah.
Because people love sports betting, obviously.
Yeah.
But from a business perspective, politics only happens on a big scale every 2 or 4 years.
Exactly. You can't build a consistent revenue stream on an election cycle. But sports, that happens every night.
Every single night.
It changes the entire addressable market.
Right.
So when that regulatory wall came down, the fintech companies had to make a choice. Do we sit on the sidelines and let DraftKings and FanDuel take all that money, or do we get in the game?
And from what our sources are saying, they didn't just get in the game. They sprinted onto the field.
They did. But they're playing different positions. You have some fintechs that are partnering with the established players, the Kalshis and Polymarkets of the world,
Right.
essentially integrating their feeds into the brokerage app. It's like plugging in a new channel. Then you have others looking at launching their own exchange platforms to capture the whole value chain.
It's interesting to see the divergence in strategy, too. The sources mention that some fintechs are specifically avoiding the retail-driven stuff like sports.
Yeah.
They want to keep it serious.
Which is a very traditional finance view.
Yeah.
We are an investment platform, not a casino. They'll stick to Fed rates or inflation numbers. But others,
Oh, yeah.
they are embracing the sports angle because they know that's where the engagement is. And in the app economy, engagement is the currency.
And engagement eventually drives volume, and volume drives revenue. Which brings us to our first specific case study. Let's talk about Webull, ticker symbol BUL.
Webull. If you want a case study in extreme volatility, this is it.
Seriously. Looking at the chart for Webull since they went public is like looking at a heart monitor during a panic attack. It's just all over the place.
That is a vivid but accurate description. Let's look at the timeline because it's important to understand the structure here. Webull debuted via a SPAC merger, a special purpose acquisition company, in the spring of 2025.
Can we take a second on that? We hear SPAC a lot, but why does that matter for the volatility?
Great question. A SPAC is basically a blank check company that is already public. It has cash but no business. It merges with a private company like Webull to take it public faster than a traditional IPO.
Yeah.
The thing with SPACs is that they often attract a very specific type of investor. Retail traders looking for the next rocket ship. It's less institutional, more hype-driven initially.
Which explains what happened next.
Right. The hype was real. The stock initially bolted. It went from around $12 a share to nearly $80 in a very short window.
That is massive. If you got in at $12 and out at $80, you're laughing.
But if you bought at $80, well, gravity took over. It quickly coughed back all those gains and then some.
So where are we sitting now in early 2026?
As of the recent data, the stock is trading around $7.34.
Ouch. From $80 to $7. That is a painful drop for anyone who bought the top.
It's brutal. The market cap is sitting around $3.7 billion. But we have to understand why. It wasn't just the SPAC bubble bursting.
Right.
The sources point out that concerns regarding the company's ties to China have weighed heavily on the shares. The geopolitical risk discount is real. Investors hate uncertainty, especially when it comes to regulation and data privacy across borders.
Okay, so the stock price is in the basement. But here's where it gets really interesting, and this is the paradox our sources highlight. If you ignore the stock price and look at the actual business, it's kind of crushing it.
It is. This is the financial paradox of Webull right now. While the stock was tanking, the underlying business was growing. In the third quarter of 2025, total revenue increased 55% year over year.
55% growth is not a number you usually see attached to a stock that's down 90%.
Exactly. And even more importantly, they pivoted from a loss to positive net earnings. They are actually profitable. That's the holy grail in fintech growth plus profitability.
So how does this connect back to our main topic? How do prediction markets fit into this profitable but unloved narrative?
Well, Webull moved into prediction markets last year. They partnered with Kalshi, and the analysis suggests this was a significant contributor to that improved performance.
So the trading volume from people betting on interest rates or election outcomes or sports, that's helping drive that 55% revenue jump.
It is, and it comes down to a concept called the velocity of money. Think about it. If you buy a share of Apple, you might sit on it for 5 years. That generates one transaction fee or one instance of order flow for the broker.
Right, it's low maintenance.
But prediction markets are high frequency. The Super Bowl ends in 4 hours. The Fed meeting is at 2 p.m. You might trade a prediction contract 5, 10, 20 times in a single session. You are recycling the same capital over and over again. That velocity generates fees at a rate traditional investing just can't match.
That makes total sense. You're sweating the asset harder.
Exactly.
So what's the outlook? Because if I'm looking at this, I see a profitable company trading at $7. Is Wall Street waking up to this?
Not entirely. The sell-side analysts, the pros who set price targets, are actually anticipating a slight earnings decline for 2026.
Really? Why if they're growing so fast?
They're generally conservative, and again, that China risk overhang makes them nervous. But here is the counterpoint.
Okay.
If you believe in the prediction market thesis, that conservative estimate might be wrong. The combination of prediction markets gaining steam, plus continued growth in their traditional stock, options, and crypto trading volumes, that could spur a recovery.
It feels like a coiled spring. If the geopolitical noise quiets down and the numbers keep going up.
It's a classic value play with a high-tech twist, but it's risky. You have to be willing to stomach the volatility.
Always. Okay, let's pivot to the other giant in the room. Robinhood Markets, ticker HOOD.
A very different story from Webull, at least regarding the stock chart.
Right. Robinhood didn't have that massive crash from a SPAC high recently. In fact, for most of 2025, they were doing great.
They were on a tear. The stock was performing very well. The sentiment was that Robinhood had matured. They weren't just the meme stock app anymore. They were capturing that younger demographic as they started to build real wealth.
But then, October happened.
October 2025, the stock entered a slump.
What caused it? Did the users just disappear?
Not disappear, but they got quiet. The company reported an unexpected drop in stock and crypto trading volumes in November. And for a company like Robinhood, volume is oxygen.
Because their model relies heavily on transaction volume, right? Even with zero commissions, they need activity.
Correct. Whether it's payment for order flow or crypto transaction fees, if people aren't clicking buy or sell, the revenue engine sputters.
And when the stock market gets boring or goes flat, people stop trading.
So enter prediction markets. Is this their life raft?
It's certainly a major part of the recovery strategy. Robinhood actually entered the space earlier last year, also via a partnership with Kalshi, so they were ahead of the curve there.
But they didn't stop there, right?
No. In December 2025, so just recently, they announced a major expansion of the types of prediction contracts users can trade.
This connects back to what we said earlier about sports and broader events. They're widening the net.
Precisely. They're trying to manufacture volatility.
Manufacture volatility. I like that phrase. Unpack that for me.
Well, you can't control the stock market. You can't make Apple stock volatile if it wants to sit still. But you can offer markets on things that are inherently exciting. If the S&P 500 is doing nothing today, maybe the user will bet on the outcome of a political summit or football game.
So it's about decoupling engagement from the stock market cycle. Exactly. Stock market flat today. Why not bet on the outcome of the Super Bowl or the next Fed meeting? It keeps the user in the app.
It's clever. It solves the boring market problem.
And investor sentiment seems to be banking on this. The sources say investors remain hopeful that the excitement surrounding this business segment can pull the stock out of its current slump. They need a catalyst to get those volume numbers back up, and prediction markets are the chosen engine.
So we have Webull using it to prove they are a serious, profitable player despite the stock crash. And we have Robinhood using it to combat a volume slump after a great year.
Two different problems, same solution.
And we shouldn't forget the third player our sources mentioned, Interactive Brokers, ticker IBKR.
Right. Now, this is important because Interactive Brokers is often seen as the pro platform.
Yeah.
It's for the serious trader with 6 monitors on their desk, not the casual scroller on the bus.
So why are they getting into prediction markets? Isn't this too gamified for them?
That's the misconception. For a serious trader, prediction markets aren't just for gambling. They are for hedging.
Okay, let's break that down. How do you hedge with a prediction market?
Let's say you manage a portfolio heavily invested in green energy stocks. You're worried that a specific candidate might win the election who is going to slash green energy subsidies. If that candidate wins, your portfolio tanks.
Right. So you have a risk there.
So you go to the prediction market on Interactive Brokers, and you buy a contract that pays out if that specific candidate wins.
Ah, I see. It's insurance.
Exactly. If the candidate loses, your stocks go up, and you lose the small amount you paid for the prediction contract. But if the candidate wins and your stocks tank, the prediction contract pays out huge, offsetting your losses.
That validates the asset class in a huge way. It's not just betting on sports, it's a financial tool.
Precisely. It reinforces that this isn't a gamification gimmick for just the retail apps. Interactive Brokers offering it means there is institutional utility here.
So let's zoom out. We've got the players, we've got the strategy, but we need to look at the macro view. What is the world looking like for an investor in early 2026?
Well, if you look at the headline numbers, it looks rosy. The S&P is at all-time highs.
Everyone loves an all-time high. It feels like a party.
Usually, yes. And you have major banks like UBS predicting the S&P could climb to 7,500 by 2026. That is a very bullish call.
That sounds fantastic. But there's always a but.
There is, and the but comes from a pretty significant voice. Bill Gates.
What is he saying?
He recently sounded an alarm, warning that many investments could be dead ends.
Dead ends. That is haunting. What does he mean by that when the market is going up?
It's a reminder that just because the index is rising, it doesn't mean every stock is a winner. In a market at all-time highs, valuations are stretched.
Right.
Finding actual value companies that will compound capital for the next decade becomes incredibly hard. You have to separate the wheat from the chaff.
And that's the synthesis we need to make here. Are these fintechs, Webull, Robinhood, part of that climb to 7,500? Or are they the dead ends Gates is warning about?
That is the multi-billion-dollar question, if you look at the bull case. These companies are diversifying. They aren't just relying on stock commissions anymore. They are building a diversified financial super app where you can trade, save, spend, and yes, predict. If that sticks, they captured the growth. They become the operating system for your money.
And the bear case.
The bear case is that prediction markets are a sugar rush.
A sugar rush, meaning it feels good for a minute but leads to a crash.
Exactly. They provide a quick spike in volume, but do they build long-term wealth for the user? If users lose money betting on sports contracts on Robinhood, do they eventually churn out? Do they stop investing?
That is a really important distinction. If I buy an S&P 500 EPF, history says I'll probably make money over 20 years.
Yeah.
The incentives are aligned. If I bet on a football game, the house usually wins.
And if the fintech platform becomes the house, or at least the venue for the house, that changes the relationship with the customer. It changes the trust dynamic.
So let's wrap this up. What are the key takeaways for you, our listener, the learner?
First, realize that the landscape has shifted. Prediction markets are no longer a fringe political thing. They are a mainstream financial product, sanctioned by regulators, covering everything from interest rates to touchdowns. Whether you use them or not, they are now part of the ecosystem. Second, look at the specific company dynamics. Webull is using this to aid a financial turnaround. They are profitable and growing revenue, despite what their stock price says. It's an interesting dislocation. Robinhood is using this to fix a volume leak. They need to get people trading again to support their stock price.
And for the investor watching these stocks,
remember that while these features are incredibly fun for users, it's exciting to trade these contracts for investors in the platforms. This is a strategic play to diversify revenue. We are in a volatile market. These companies are trying to ensure that even if you aren't buying stocks, you are still generating fees for them.
it's about being an all-weather business.
Precise.
You know, this conversation raises a thought that I can't quite shake. We're seeing these platforms, which started as tools to democratize investing, giving power to the people to build wealth, now pivoting hard into what is essentially gambling.
It's a thin line.
It is. And here is the provocative thought I want to leave everyone with. If these fintech companies are relying on prediction markets, literally gambling on outcomes, to stabilize their own stock performance, does that blur the line between investing and betting for the platforms themselves?
That is a fascinating and slightly uncomfortable question.
Are they becoming less like banks and more like casinos, where the only reliable growth comes from the rake on a wager? If they rely on the house always winning to hit their earnings targets, that is a fundamental shift in what these companies are.
It certainly changes the valuation model. If they are casinos, we should price them like casinos.
Something to mull over the next time you open your app and see a prompt to bet on the game. Thanks for listening to this deep dive. We'll catch you on the next one.